In this video, we will take a look at Chapter 9, Adjusting Entries. These are going to be the entries that are going to be similar to the Chapter 3 in the big accounting textbook, which were the adjusting entries in which we adjusted the trial balance at the end of a certain period, either the end of the month or the end of the year, in order to have our financial statements be correct as of that date. And we had to accrue or fix basically certain timing differences. And the key accounts were accounts such as the depreciation had to be calculated, and the prepaid insurance had to be adjusted, and any other type of accruals such as accrued interest and this problem will also have to be adjusted. So we will actually be using journal entries in this problem, which we have pretty much avoided throughout most of this book. You know, QuickBooks has set it up in such a way that many things can be done without the journal entry process. This is one where the adjusting process really does kind of need the journal entries. We don't do it with forms as much. And so that's what we're going to do. We're going to skip to the beige boxes, so go ahead and read through here to get more context as to what we are doing. And then, of course, the activities that we will perform will be the ones in the highlighted areas. So the first one is to accrue interest expense. It's on page 265. And of course, our first problem and challenge is to restore the Wild Water Sports Chapter 9 file. Now, we're going to have to do this every time. We're going to have to restore a new file, and this is one of the most difficult things for many students, is to actually just restore these files and organize them and make sure we're in the right file. So make sure you do that correctly, because it's really frustrating to work on the wrong file. So we're going to get this from either the data file on your CD that came with the book, or you can get it from Moodle. So we put it into Moodle here, and that's where I'll show you how to get it from. So we need to download the data file, put it on our computer, then open QuickBooks, and then restore the data file before we can really get going in this problem at all. So let's do this. We're going to go to Moodle, and I'm going to scroll down. I'm in week 4, and if you go down to the bottom of week 4, you'll see the week 4 data files. So I want to click on that data files. It gives us this set of data files. We got 9, 10, and 11. And of course, we want to work the 9 and not the 9A file for now. So I'm going to open up the Chapter 9 file. Now, I'm in Google Chrome, indicated by this little Chrome sign down here. That's the browser. If you happen to be in Firefox or in Explorer, it's going to download a little bit differently. The point is, however it downloads, we don't want to open it because we can't. What we need to do is save it to the desktop or some area that we can then restore it. So if we click on this in Chrome, I'll get a little icon here, and it's, you know, downloading. And if you're in Firefox, you'll get a little icon up here. If you're in Explorer, you'll get a little ribbon down here, this yellow ribbon. And whatever it does, once it opens up, I can't click on it right now because if I do that, it'll try to open it, and I can't open it. What I'm going to do is go to the Show All Downloads right here, and that will show me the download. And then I want to put this onto my wherever I want to put it to open it. So what I'm going to do is take this and put it over here, minimize everything else, and then I want to go into where I want to put it. I'm going to put it in this folder on my desktop. So I'm going to double click on that. I'm going to snap this on this side, and then I want to go into the backup files. So I want to put it in the backup files. Then when I restore it, I'll restore it to the data files. So I'm going to go into the backup files. I'm just going to take this Chapter 9 and drag it on in to this file, and now there we have it there. Now, if that process is giving you problems, you could use the CD to do that as well, and just make sure you locate the Chapter 9 file. Once we have it somewhere where we can locate it, then we need to open QuickBooks, and we want to open the 2013 version. And your 2013 version will probably open to Wild Water Sports, but it will be and I'm going to install later here, but it will be Wild Water Sports for Chapter 8, most likely. I have 5 days remaining. Remind me later. Okay, and so we cannot use this even though it's going to be a very similar file. Even though it's a very similar file, it can't be used because it's the Chapter 8. So if you start working on this one, it'll look kind of right, but it won't be totally right because we're not using the right file. So we could close this company. We don't really need to, though. if we go through the opening or restoring process, this company will close automatically. So we could just go to the File tab, as I'm doing over here, and scroll down to Open or Restore, third option, and click on that. Now we don't want to open a current company. What we want to do is restore a company. So we're going to select the second item, and then Next. And then I'm going to get the local backup, not from online. We're going to get the backup from the computer. Now it's already going where I want it to go because that's where we went last time. But if it were not going where we wanted it to go, I could go to the desktop. I'm looking for AC1320, and we just put that file in the backup files zipped folder. And make sure we pick up the Wild Water Sports Chapter 9. Going to double click on that in order to pick that up. And then it says, where do you want to restore it to? Now I'm going to restore it to a new location. So notice if I hit this drop down, it's going into this folder, into there. I'm going to go back to this folder because I don't really want it in the same location. If you do put it in the same location, that's okay, not a big deal. Just make sure you know where it is in case you need to get out of this and go back into it. I'm going to put mine into these data files here where we have the data files. So we have Wild Water Sports 6, 7, and 8, and now we're on Wild Water Sports 9. And that will take a little bit to upload here, and once it does, then we can continue it. Now if it has this, do you want to continue? Yes, we do. And then it'll boot up here. So once we have that, number 2 will then says click company and then make the journal entries. So pretty much everything we do at this point forward will be with journal entries. If a message pops up about assigning number to journal entries, check do not display this message in the future checkbox and then click OK. The journal entries are all going to be as of 3/31/13 because that's our cutoff date. Number 8 will be the journal entry number, and then we're going to select interest expense as the first account. Okay, has been restored successfully. That's good. Why does it give me? Once the file has been opened, I often like to go to the View tab at the top and go to Open Windows so that we can see the open windows on this side. Now, since we are working a adjusting process, I would like to just open the trial balance and explain what is happening as we go. So I'm going to go to Reports. You don't have to do this, but I'm going to just pull this up. Accounting and Taxes and Trial Balance. This is the form that we have been making when we have been doing our accounting from the bottom up, when we did it basically by hand, by T accounts to the general ledger to the trial balance. And we're working on the month of March, so our cutoff date is, I'm going to put it through the month of March, 03/31/13 to 03/31/13. It'll actually start at the beginning of the month, even though it doesn't matter. Okay, so here's our trial balance here, and the first thing we're going to do is accrue interest, which if we look at it, of course, that would be accrued interest at the top. That would be our balance sheet account. And down here it'd have to do with interest expense. So we're probably going to debit interest expense and credit accrued interest. Why? Because we owe interest and we have not yet paid it till after the cutoff date. So it's going to tell us exactly what we need to do though. So we need to go to the company at the top, and we need to go to the journal entries. Make journal entries. Here it is down here. So we want to make journal entries. Select that and then say do not show me this again as instructed, and OK. Now make sure we have the date as of 03/31/13, and the journal entry number 4 says it was 8. That's the journal entry number, and it's an adjusting entry, so I'm going to keep that checked. Number 5 says select interest expense. So that's going to be the debit. I'm just going to start typing that in there, interest expense. And we'll type in, number 6 says the interest expense was 1010.97. Tab, tab, tab. And I'm just going to tab down to the, now notice it puts the credit in there automatically. It's trying to guess. It's going to force us to do that. Notice we cannot be out of balance in QuickBooks because it won't let us. What we can do is not know where this other side should go and put it to somewhere strange. So we want it to go to accrued, which is a new account apparently. So I'm going to type in accrued liabilities as the second account. We'll hit tab, and it says, do you want to set that up? And we're going to say yes, please set that up, because we don't have that. And number 8 says click setup in the account not found window and create a new account called accrued liabilities and other current liabilities. So this is a liability type account. So I'm going to go down here to the drop down. It's going to be an other current liability type of account. We then hit continue. We then see this screen which it has other current liabilities at the top, which that's other current assets. We want other current liabilities. Sorry about that. Other current liabilities is going to be called accrued liabilities here, and that's what we want. So I'm going to hit save and close. Number 9 says 101097 should now appear in the amount in the credit column. This will increase accrued liabilities. Click the hide list button in the ribbon shown at the top of the make journal entries window. I think that might be this. Okay. And the results in journal, and then we can turn to the next page. We are now on page 266, and we have number 10 says save and new. So we can now save and new that. So I'm going to go down here and hit save and new, because we're going to do another journal entry after that process. If we wanted to see what happened, of course, what happened is we owe interest that we're not going to pay till next period. So we're not going to pay it till sometime in April. So if we wanted to look at what happened, the liabilities of course went up. We put this new accrued liabilities. If we double click on it and we double click on that, there's the journal entry we just entered. So we increased the liability and we increased the expense for basically the rent on the money that we borrowed that we have not yet paid yet but owe and will pay in most likely April. Alright, back to the journal entries. So we'll go to, I think I just closed them. Make journal entries. We're on the number 9. Okay, so back in the book, it says, number 10 says, click save and new. Number 11 says we want 33113 should appear at the top. 9 should appear as the entry number. That is what it is. Number 13 says select interest expense. So we're going to do the same thing, except that this time it will be for $750. And then we're going to increase the liability $750, and then we'll go save and new once again. So tabbing through this, the first account is going to be called interest expense, and that will be for number 14 says it's for $750. Tab, 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 tab. Don't need any of that other information at this time. Number 15 then says the other side will be accrued liabilities. Here we go, and the credit pops up automatically, and then we will hit save and new. Now of course we looked at the trial balance. The other loan is also going up here, and now our accrued liabilities consist of these two amounts that we owe and have not yet paid. And we will then go to the next page, which is page 267. To reverse all accrued expense entries. So this is a little bit confusing for some people to understand. It's for anybody to understand. It's some of the entries that we put in we're going to reverse, and I'm going to try to explain this real quick as to why this would happen. We're basically putting in these entries here in the trial balance, and we have this accrued liability. Now I'm going to try to separate the accounting department from the adjusting department, and try to indicate that the adjusting department may be an outside CPA firm, or it may be a different department. And what we're going to try to do in the adjusting department is make the accounting department's job as easy as possible. Meaning, I don't want the accounting department to have to worry about our accruals. I don't want them to have to know and reverse our accruals. So for that reason, we're going to do things that aren't exactly on an accrual basis in time periods that is not the end of the month. So we made it right as of the end of the month here, so that we could create the financial statements as of the end of the month. We don't really care that it was not right as of March 30th or March 29th. It wasn't right as of those days. We don't really care too much because we're going to use the financial statements and make them official as of March 31st. So in April then, we don't really care if it's a little bit off on April 1st as well. What we do care about is making sure that what we care about more is making sure that the accounting department doesn't have to worry about our accruals. So since we made this correct as of this date, we want to then just fix it in the first day of the next month. So for that reason, what we're going to do is reverse this as of the first day of the next month. So after the cutoff date, we're going to reverse this, which means we're going to have a negative expense for the month of April, which is totally wrong, but it will fix itself when the bookkeeper then or the accounting department records the payment on the loan, and it's easier for the accounting department to just do what they do and just record the payment in accordance to the amortization table rather than having to worry about reversing this accrual. So we're going to reverse this accrual as of April in order to make it easier on the accounting department so that they don't have to really understand what we're doing with this accrual thing. So that does happen in practice a lot, although it is not really the most accurate accrual basis in terms of every date other than the financial statement date. So, but this is what we'll do. As of April, you want to make sure you change the date to April 1st. And then 10 should appear. Select the accrual liabilities and type 1097, and then interest expenses, the second account. So now we're exactly reversing what we just did. So the first account is going to be accrued liabilities. This time we're going to debit that account for 1010.97, tab, and then we're going to credit, number 5 says, the interest expense. So we're exactly reversing what we just did as of the next day, and then we'll hit save and new. And of course, if we look at our trial balance now, it's still there as of the 31st, but as of the 1st of April, now we're down to 750 because we now took it out of there. We took it back out. Okay, so let's do the same thing. We're probably going to do the same thing for the next one. So it just says, number 7 says save anew. Number 8 says repeat the same process to reverse the 750. So same idea, we're going to debit the accrued liabilities for the 750. So as of the 1st of April, accrued liabilities for the 750, and then the credit will be interest expense. And then we'll hit save and close this time. And once again, now we have no accrued liabilities as of the 1st, but as of the 31st, it's correct. So we made it right as of the 31st. We reversed it as of the 1st, and then it will be right once the accounting department makes the payment, and they don't have to worry about reversing this accrual when they make the payment. Okay, so let's go to page 268 now. So the next page is 268, and it says we're going to accrue interest income. Number 1, click the company, and then click Make Journal Entries. So we're going to go to the same area, Make Journal Entries. We're going to type the 31st. So back to the 31st, and we're going to have 12 should appear in the journal entry number. Number 4 says we're going to select the short-term investment account. We're going to type 1090.41, and then interest income in the second account. So what is happening here on that accrual? The other side of it is happening. Notice that we have money in the short-term investment account, and of course the reason we have it in there is because we hope to make dividends, interest, and maybe capital gains on that money. And in this case, they owe us money on that. They owe us interest on it that they have not yet paid us. So we're going to increase the investment for that interest that is owed to us for the money that we loaned out, the rent on the money that we are earning in this case. And the other side, of course, would then be interest income down here. So we're going to make the accrual correct as of the 31st again. So I'm going to go this way. I'm going to go to company. That's how I go into the journal entries and go into Make Journal Entries. So we ever just make sure the date should now be the 31st, not 4/1. And we'll do the same process, except for now we are earning the interest. So the first account will be the short-term investment. So number 4 says short-term investment, and number 5 says we got 1890.41. We don't need any of this. And then number 6 says we have interest income. So make sure you have interest. Okay, so there is no interest income, so we'll say interest income as the second account, and then we'll have to set it up. So I'm going to hit tab. We're going to set up this account. This is going to be an income type account, but it's going to be an other income. So we're going to go down here and we're going to select other income and hit continue. Then it's an other income account named interest income. And number 9 says we hit save and close and then save and new. Alright, so if we look at this, now of course what has happened is that this account is going up and we have this new account down here called interest income. Now if your account doesn't show up down here in interest income, it is most likely because we set it up as an expense or something other than an other income account, because this is sorted in the order of assets, liabilities, owner's equity, income, and then expense, and then other income and expenses down here. And of course, there's our transaction here. All right, what do we have next? Scrolling down to the bottom of page 268, we have a new box with a new objective, which is to reverse the interest income accrual. So let's explain that real quick, because that is often confusing to folks. And now we have this interest income. The same idea is that we want to reverse this because we don't want the accounting department to have to worry about it. So we made it correct as of March 31st, and then we're going to reverse it as of March 1st, so that when we actually receive the interest income, the accounting department can just record it as they normally would and does not have to worry about reversing our accrual when that happens. So we're going to make this as of the 4/1 and do this adjustment. So it says type 4/1, 13 should appear. Interest income is the first account, reducing interest income. That's the amount. And then the other side, the credit, will be short-term investments. So we're just reversing exactly what we just did. So we're going to say interest income is now going to be debited. Number 4 says for the amount of 1890.41, and then tab, tab, tab. The other side will be short-term investments. Then we can hit save and new, which is what number 7 says, and now we've reversed that. So now we've taken it back out as of the 1st. So now we're back down to 38 as of the 1st. We made it right on an accrual basis as of the cutoff date, so that we could make our financial statements as of that date. So notice we're not worrying about any date other than that to be perfectly correct in regards to these accounts. We're preferencing simplicity over complete accuracy on every day other than the cutoff day. So then we're going to go back here again, and we're going to go to the next account, next day, which is 269 is the page. And we have a new objective of to adjust the sales occurring in March, but not invoice until April. Okay, so let's tell the story on that one real quick. These would be items that if we sold, say, a boat, and we gave them the boat in March, but we didn't actually write the invoice until April, that would be a case that we have earned the revenue and we did bill it, but we billed it in the wrong month, and we need to bring it back into March. Now this may not happen so much in this type of business, but it would happen a lot if it was like a law firm or some kind of service business, in that we would have to basically figure out what the bill is before we can bill the client. So oftentimes the bill will go out after the work had been done, and to be really accurate in terms of an accrual basis, we need to bring the work into the period in which it was earned. So this is the revenue recognition principle, meaning that they did it right. They did bill and invoice the client and recognize revenue, but they did it in the following month. They did it in April. and we need to bring it back into March because the boat was actually shipped or actually given to the client in March. So that's what we're going to do, and let's see how we're going to do it. So let's see. So type 331, 14 should appear, and then we're going to select, now this is the journal entry behind an invoice. When we make an invoice, this is the journal entry that happens. So we're going to select accounts receivable, that's going to be debited for 69225. And anytime we hit accounts receivable, we do have to hit a customer. You cannot post an entry to accounts receivable without choosing a customer, because QuickBooks is going to force us to make a subsidiary ledger, meaning an accounts receivable in order by customer report. Then we're going to select boat sales. That's going to be the credit for us earning income sales. That's going to be for $65,000, so that's the cost. And then that's also going to be Spirit Adventures. And then select the sales tax payable. So whenever we make a sale, we're going to have to have sales tax on it. That's a liability account. It's going to go up by 4225. Bank of Florida Department of Revenue is who we owe that to. Same idea is that that's a payable account, and QuickBooks is going to force us to put in who we owe it to so that it can make a payable subsidiary account ordering the payables who we owe by, in this case, vendor. Then we're going to select cost of goods sold, and that's the expense account related to us making this sale, the expense being the inventory we had to give up. The cost, $52,000, Spirit Adventures, and then we're going to reduce inventory in the boats, obviously representing the fact that our inventory is going down by $52,000. So I'm going to go through those steps in here now. So number 1 says the date should be 3/31. Make sure that's correct. It's the 14th. That's correct. Number 3 then says the first account is accounts receivable. So accounts receivable, and people are going to owe us 69225. Now we do have to put a customer. Don't really need a memo, but we should put a customer, and it's going to be Spirit Adventures. All right, that sounds fun. All right, and then we're going to have boat sales. So I'm going to put in boat sales here, and that's going to be the credit, but the credit is only for 65,000. So that's what we charged for the boat, but they're going to pay us more than that because, of course, they had to pay us not only the sales price, but the sales tax on that. And once again, we'll type Spirit Adventures, which is not as necessary in this account. And then number 9 says we want sales tax. So the difference is sales tax, and it's sales tax payable. The reason it's a credit is because a liability is going up, because we don't get to keep that difference. So these two equal that now, and we're going to have to pay that to number 11 says the Florida Department of Revenue. Okay, so the government is our silent partner at all times. And then number 12 says select cost of goods sold. So cost of goods sold, that's going to be the expense related to the sale, and that's 52,000. And we could select Spirit Adventures, although it's not really required in this field. Spirit Adventures, and I'm going to uncheck this billable because I don't want to create an invoice on it. Maybe I do have to check that. It doesn't tell me. Okay, I'm going to keep it there. Okay, Spirit Adventures, cost of goods sold, 52,000. Number 14 says select Spirit Adventures, and number 15 says boat inventory. So we got inventory on the boat, which is going to be credited, reducing the inventory, and that will also go to Spirit Adventures. Alright, and then turning the page to 270, it says mark cost of goods sold inventory boats as unbillable. Okay, so I was jumping ahead there. So mark cost of goods sold as unbillable by clicking the billable icon. So the checkbox is unchecked. Your journal entry should look like on 9/4. Okay, I'm going to say it does. I'm going to uncheck these, and hopefully our journal entry looks like it should on 9-4, which is on page 271. Actually, it's on page 269. Okay, we look good. So I'm going to hit save and new. And so now, of course, what happened if we looked at the trial balance is that accounts receivable is going to go up, and we owe the sales tax on the boat, got credited. Boat income is going to go up. Now what we're going to do is probably reverse that. So let's take a look at what we have next. We're going to go to the next item on 270, and the next beige box says to reverse the sales. So if we take a look at this, we now put the sale in there as of 3/31. Now the accounting department did put the sale in there, but they put it in there in April. We have to reverse this one, or else the books will have recorded it 2 times. So we made it right as of the 31st by pulling the sale that was recorded in April into March in order to make our income correct as of March. Now we need to reverse it as of the first day of April so that it doesn't get recorded 2 times. So all we're going to do is take the exact entry we just did and reverse it as of the first day of April. Okay, so let's do that. And the first one says we're going to type in the date of 4/1. 15 should then show up. Select the accounts receivable account. Type 69225 in the credit column. So make sure it's in the credit column. Select Spirit Adventures, and then select the boat sales, and that's 65,000. Then select Spirit Adventures, and then select the sales tax, which we're going to reverse was 4225. Select the Florida Department of Revenue, then cost of goods sold 52,000, Spirit Adventures, and then inventory boats, and make it unbillable. So I'm going to go through those steps here. So number 1 says we want to make it as of 4/1, and then number 2 says it should be the 15 should show up. Number 3 says select accounts receivable, and make sure that we are in the credit column, because number 4 says in the credit column we should have 69225 because we're reversing the transaction we did in the prior step. The customer will be Spirit Adventures. And number 6 then says we have boat sales, and that number 7 says that should be debited for 65,000. And number 8 says it's going to go to Spirit Adventures. Then number 9 says we have to select sales tax, so we're going to reverse the sales tax payable account. So we're going to reverse that. Number 10 says that's for 4225, which is what shows up here. And number 11 says that's the Florida Department of Revenue. And number 12 says then we select cost of goods sold and type 52,000 in the credit column, so 52,000 reversing this account. And number 13 says Spirit Adventures, and number 15 says inventory on boats, and number 16 says accept the 52,000 amount as the debit. That's correct. And number 17 says Spirit Adventures, so we'll type in Spirit Adventures. Number 18 says mark cost of goods sold and inventory boats as unbillable by clicking the billable icon, so the checkbox is unchecked. So we will then uncheck these items here. And then on the next page on 271 it says save and close. So we'll hit the save and close. And if we analyze this now as of 4/1, we have reversed this back out again. So if we take a look at our boat sales for that time period, we increased the boat sales, increasing this account here, making it right as of our cutoff of 3/31. Then we reversed it back out because most likely the the bookkeeper did put it in there. They just put it in there as of a later date. Let's see if the problem actually did that, just out of curiosity. Yeah. So here's and then here's the actual sale that happened. It happened on 4/10, So what really happened is they'd made the invoice as of 410, and the problem is telling us that the boat changed hands in March. So we had to pull this into March and then reverse it because the real sale happened on 410. Okay, so let's see what else we have here. Back to the book, going to page number 271. We go to the bottom of page 271. We have to adjust prepaid advertising. Alright, so now we're going to adjust the prepaid advertising. So click company and then click make journal entries. Type 331 as the journal entry. Click 16 should appear. Number 4 says click advertising and promotion as the first account. Type 4000 and select prepaid advertising as the second. Alright, so if we take a look at this and we take a look at prepaid advertising, if we have an account called prepaid advertising, that must mean that we paid for advertising in advance. We prepaid advertising. That is an asset. The reason we put it on as an asset is because we paid for advertising that we have not yet received, and we're going to recognize the expense of advertising as we use that advertising in order to help us generate revenue. So that's the goal. Therefore, we're going to figure out how much of that advertising has been used, and we will expense it by debiting the expense and reduce the prepaid, the asset, by crediting it. So in order to do that, we will go to the company. We'll go to make journal entries, and here's our journal entry. So number 2 says we want to make the date 3/31, and then number 3 says 16 should appear. Number 4 says that the account should be advertising and promotion. That's an expense type account, which will increase the expense, decreasing net income, amount being 4,000. Then the second account will be prepaid advertising, an asset type account, other current asset in this case to be more specific, and we're going to reduce that by crediting that account. Then we can turn the page to the next page, being 272, which says we type 4,000 and then select save and new. So save and new, and now of course what we did was increase the advertising expense by that 4,000, and so it was an insurance expense. So we increased the advertising expense by that 4,000 and took it out of the prepaid advertising. Okay, let's see what we have next. And then it says to adjust prepaid insurance. Now notice we're not reversing that one. That one is not reversible. It's not like it's a timing difference. That is something that we have to adjust because our accounting department is just increasing. Every time they pay for advertising, they're putting it into advertising, prepaid advertising. So every time they pay for it, they credit cash and they put it into prepaid advertising. And then we have to adjust it for a permanent adjustment, decreasing that account as we use that advertising, and so we do not reverse that one. Alright, the next one, to adjust prepaid insurance. So this is the same idea. This is the most classic kind of prepaid item that every company has. So the account is going to be 331.17 should be the number that pops up. Insurance expense for 5,005. Then we're going to credit prepaid insurance for 55, save and new. So let me just explain that one real quick. Prepaid insurance is right here, same idea. When we buy insurance, by definition, we have not yet used insurance because we pay for it in advance to cover some time period in the future. Therefore, we have the accounting department just whenever they pay for the insurance, they credit cash and debit prepaid insurance. And then at the end of the period, we need to go in there and say, well, how much of that insurance has been used? Meaning, how much time has passed? How much of that insurance has helped us to generate revenue in the month of March? That is what we need to charge as an expense in that time period and reduce the asset by that amount. So the book says that that amount is what they tell us to be in this section. So number 1, make sure the date is 3/31. 17 should show up as the number. The first account will be insurance expense. Expenses generally only are debited, and this one will be debited, increasing the insurance expense, which will decrease net income. And number 5 says the other account is going to be prepaid insurance. That's an asset type account. The asset is going down. Assets have a debit balance. We make things go down by doing the opposite thing to them, thereby crediting the account. In this case, then we can select Save and New. And if we take a look at what happened, prepaid insurance did indeed go down because it is indeed a debit balance account, and we credited it, making it go down to 16.5, representing the use of insurance for the month of March. Okay, what we have next, if we go to the bottom of this page, bottom of page 272, we have a new box with a new objective of to record depreciation expense. So first, accept the 331 as the journal entry date. 18 should then show up. Select depreciation expense as the first account. Next page, we're on page 273, says type 1033 as the amount, select accumulated depreciation as the second amount, and then accept 10333 as the amount. So let's discuss that real quick. Accumulated depreciation, what is that? That is the depreciation of the equipment in this case. So we have furniture and equipment of $295,000. The reason it's an asset and not an expense is because we have not yet used it in order to generate revenue, and that is an accrual principle. Therefore, we put it on the books as an asset, and we will expense the use of that asset as it is used in order to help us generate money in the same time period. That's the accrual principle called the matching principle. We do that not by decreasing the asset account directly, because we want to tell our reader, hey, this is just an estimate. It's not like the furniture and fixture disappeared. The couch didn't disappear. We're just saying that we're going to allocate the cost over what we believe will be the useful life of the couch. Therefore, we are going to create a new account called accumulated depreciation, which is related to the furniture and fixture type account, and it represents the amount that that account has gone down by. So what we will do is debit depreciation expense for the use of the furniture and fixture, which is an estimate, and credit accumulated depreciation, reducing the book value. So they're just going to give us these numbers to do that. And so number 1 on page 272 says the date should be 3/31. 18 should pop up. Number 3 says we're going to select depreciation expense. It's an expense account indicated here and here. And we're going to increase expenses because they generally always go up, and when they go up, they decrease net income as well as owner's equity. We're going to put in this account 10333, tab through this, and number 5 says the second account should be accumulated depreciation, which will be the credit, and we should look like the picture on figure 9.5, which we do. And then number 7 says save and close, and so let's do that. And if we go here now, of course the accumulated depreciation has gone up, which brings the book value down, and we have also increased depreciation expense, reducing net income. Okay, so now we're turning to page 274. So if we go to page 274, it says to view the fixed asset portion of the balance sheet as of March 31st. So let's take a look at this and see if we did it correctly. From the Report Center, create a standard balance sheet. Type 331 as of the text box. Remove the date prepared, time prepared, and report basis fields as you've done in the past, and then click refresh and follow Karen's analysis. Okay, so we can go. I would do it this way. So we're gonna go. I'm gonna go to the reports drop down this time. You can also go to the reports the way we've done it in the past, but I'm gonna show you this is another way to go in there. It probably is a little quicker. And you go to company and financials, and then we want to go down to balance sheet. So if you hit the report drop down, company and financial, down to balance sheet here, here's our balance sheet. We want to make the date 03/31/13, and then we can customize it if we want and get rid of go to the header and footer tab, remove the date prepared, time prepared, and report basis. And that gets rid of these 3 things. Okay, so if we take a look at this, the total assets and liabilities should come out to 1036594 as it shows in the book, and the so that looks okay. The total looks okay. The total assets here. And then here's our fixed assets of 277, 167, and of course we're just comparing, I'm just comparing it out here, and they just showed a portion of the report, so they didn't show all of it. So down here we've got total, here's a portion of the first half of the report. So here's this number, here's this number, here's the total fixed assets, and this ticking and tying is a good thing to get good at. So the first thing I would look at when looking at a report is the bottom line, which is total assets should equal total liabilities plus owner's equity, and then go to the subtotals. If this number does not tie out, then let's take a look at the big subtotal numbers and see which of these are off. If, for example, this one was off, then we would go into the detail. Well, which of these numbers that is in creation of that? This is the sum of these numbers. So if this number is off, one of these numbers must be off. And that's the kind of way you want to be able to dig down through this. All right, so then it says, let's see, make this large. And then number 4 says, close all windows, do not memorize the report. Okay, and then we will